Have you heard about the massive $4 trillion event shaking up the global markets? It's a number so huge, it's hard to even wrap your head around it. But what does it actually mean for your money, for the economy, and for the future? Is this the start of a major market recovery? Or is it a sign of something much deeper, a structural shift that could change the rules of the game for years to come? Let's break it down. So, where did this $4 trillion come from? Well, it's not just one thing, it's a combination of factors. We're talking about massive central bank interventions, huge government spending packages, and a surge in market capitalization for certain sectors, especially in tech. Think of it like this. Governments and central banks have been pumping enormous amounts of money into the system to keep economies afloat during recent crises. At the same time, companies leading the charge in areas like artificial intelligence and green energy have seen their valuations skyrocket, adding trillions to the market. Now, the big debate is what this all means. On one hand, you have the optimists. They see this $4 trillion injection as pure rocket fuel for the markets. They believe this liquidity will continue to push stock prices higher, stimulate consumer spending, and lead us into a new era of economic growth. From their perspective, this is the cavalry arriving just in time, paving the way for a strong and sustained market recovery. They'll point to rising stock indices and say, see, the recovery is already happening. But on the other side of the argument, you have the skeptics, and they're raising some serious red flags. They argue that this isn't organic growth. Instead, they see it as an artificial bubble inflated by cheap money. Their concern is that all this cash is distorting the true value of assets and creating massive risks. What happens when the support is withdrawn? They believe this event isn't a sign of a healthy recovery, but a signal of a major structural change in our economy. We might be shifting towards a system that's permanently dependent on government and central bank intervention. This could lead to higher inflation, devalued currencies, and increased market volatility down the road. They're asking, are we just kicking the can down the road and setting ourselves up for a much bigger crash later on? So who's right? The truth is, it's probably a bit of both. We are definitely seeing a short-term boost from all this stimulus, and that's undeniable. For many investors, this has created incredible opportunities. But it's also crucial to look at the bigger picture. We're in uncharted territory. The global economy is undergoing a fundamental transformation, driven by technology, geopolitics, and these massive financial interventions. What does this mean for you? It means it's more important than ever to stay informed and think critically. Don't just ride the wave of optimism without understanding the underlying risks. Diversifying your portfolio is key. Look beyond the headline-grabbing tech stocks. Consider assets that might perform well in an inflationary environment, like commodities or real estate. And most importantly, keep learning. Understanding these huge macroeconomic trends is no longer just for Wall Street experts. It's essential for anyone who wants to secure their financial future. This $4 trillion event isn't just a news headline, it's a wake-up call. It's a signal that the financial world is changing and we need to be ready to adapt. Among all assets involved in the recovery, silver and gold provided the clearest diagnostic signals. Their behavior did not merely accompany the broader rebound. It contradicted the interpretation that the rebound represented renewed confidence. Precious metals, when analyzed correctly, do not function as directional bets on growth or risk sentiment. They function as instruments that reveal stress, trust, and the credibility of financial structures. Silver's rebound was the most extreme and therefore the most informative. Unlike gold, silver occupies a hybrid position within the global system. It is both an industrial input tied to manufacturing cycles and a monetary metal tied to financial confidence. When silver moves sharply, it is often because those two roles are colliding. A 20% rebound in such a short window indicated not a sudden improvement in industrial demand, but a violent repricing of risk embedded in financial positioning. During the preceding sell-off, silver had been sold aggressively, not because end users disappeared, but because leverage positions were unwound. Futures markets, where silver is heavily traded relative to physical supply, amplified this effect. Once liquidation pressure eased, the rebound was mechanical and disproportionate. This was characteristic of a market where paper claims dominate price discovery. The speed of the move exposed how detached pricing had become from underlying supply and demand realities. Gold's signal was subtler but more consequential. Gold does not respond primarily to growth expectations. It responds to confidence in currencies, in balance sheets, and in the reliability of counterparties. An 11% rebound in gold alongside a massive equity recovery suggested that participants were not rotating out of safety. They were rebuilding it. This behavior directly challenged the notion that risk had been resolved. Historically, periods in which equities and gold rise together tend to occur when liquidity is abundant but trust is fragile. Capital flows into equities because alternatives are limited and opportunity costs are high. Simultaneously, capital flows into gold because the system producing those opportunities is perceived as unstable. The coexistence of these flows is not contradictory. It is symptomatic of late cycle or stressed environments. Another important signal emerged from the divergence between precious metals and related equities. Mining stocks, which offer operational leverage to metal prices, did not match the magnitude of the metals rebound. This divergence suggested skepticism about the durability of the move. If the recovery were rooted in improved fundamentals, mining equities would typically outperform the metals themselves. Their relative underperformance implied that markets were pricing a liquidity event, not a sustained upswing. This distinction mattered because it separated price action from confidence in future cash flows. Metals rose because they serve as balance sheet insurance. Mining equities require belief in stable operations, predictable costs, and supportive financing conditions. The reluctance to fully reprice those equities indicated that such belief was limited. From a strategic perspective, the metals' behavior pointed toward currency and counterparty considerations. Gold, in particular, is increasingly held by institutions as a hedge against systemic risk rather than inflation alone. Its rebound reflected concern about the conditions that made a $4 trillion recovery necessary in the first place. In effect, gold was responding not to the recovery, but to the system that produced it. Silver added another layer to this signal. Because of its role in industrial supply chains, extreme volatility in silver prices introduces uncertainty for manufacturers and investors alike. Such volatility complicates planning and hedging, increasing the cost of doing business. The sharp rebound therefore highlighted not opportunity, but instability in price formation. Taken together, silver and gold acted as stress indicators rather than speculative vehicles. They revealed a system where leverage-driven selling had pushed prices below sustainable levels, and where the rebound corrected that imbalance without resolving underlying vulnerabilities. Their performance suggested that trust in the financial architecture remained conditional. For business leaders and capital allocators, the lesson was not to interpret metals gains as a trade signal, but as information. Metals were signaling that balance sheets were being protected even as markets celebrated recovery. This dual behavior underscored the central theme of the episode. Capital was hedging against the very volatility it was forced to chase. Thus, reframed silver and gold as analytical tools. They did not confirm optimism, they exposed caution. Their movements indicated that, beneath the surface of rapid recovery, concerns about currency stability, liquidity reliability, and systemic coherence persisted. These concerns would shape decision-making long after the immediate rebound faded from headlines. Liquidity mechanics, how capital actually moved. To understand how $4 trillion appeared to return to markets in little more than a day, it was necessary to move beyond headlines and examine the mechanics of liquidity. Markets do not move because of abstract confidence. They move because capital is forced, incentivized, or constrained to act. The recovery was not the product of discretionary optimism, but of structural processes embedded in the modern financial system. At the center of the event was liquidity, specifically the difference between apparent liquidity and functional liquidity. Apparent liquidity is what markets display during normal conditions: tight spreads, deep order books, and continuous pricing. Functional liquidity, by contrast, is what remains when volatility rises, leverage is stressed, and participants must transact regardless of price. The preceding sell-off had revealed how quickly apparent liquidity could vanish. The recovery revealed how aggressively systems respond once functional liquidity reappears. As prices declined, margin requirements rose automatically across derivatives markets. Leveraged participants, particularly those operating with futures, options, and total return swaps, were required to post additional collateral. When collateral could not be posted quickly enough, positions were reduced or liquidated. This process was not selective, it was mechanical. Assets were sold not because they were flawed, but because they were liquid. This dynamic accelerated the downturn and concentrated stress in markets that could absorb volume. Once selling pressure reached its limit, the same machinery reversed direction. Volatility began to compress, even marginally. That compression triggered a cascade of responses. Volatility targeting funds, which reduce exposure when volatility rises and increase it when volatility falls, began to rebalance. Risk parity strategies adjusted allocations. Market makers widened, then narrowed spreads, re-entering markets as price action stabilized. Short sellers, having benefited from the decline, were incentivized to cover positions rapidly. This sequence mattered because it created synchronized buying across asset classes. The recovery was not driven by individual investors making long-term judgments. It was driven by systems designed to respond to volatility thresholds, correlation shifts, and risk budgets. When those thresholds flipped, buying became compulsory rather than optional. Liquidity provision also played a critical role. During the sell-off, dealers and intermediaries reduced balance sheet usage to preserve capital and comply with internal risk limits. As conditions stabilized, balance sheets were redeployed. This redeployment did not represent renewed faith in valuations. It represented an opportunity to intermediate flows at advantageous spreads. In doing so, intermediaries amplified the rebound by facilitating volume that had been suppressed only hours earlier. Crucially, much of the capital involved in the recovery was not new capital. It was the same capital that had been forced out during the downturn, now re-entering under different constraints. This distinction undermined the narrative of fresh inflows and renewed confidence. Capital did not return because the outlook improved. It returned because remaining out of the market became mechanically untenable for certain participants. The behavior of precious metals during this phase further illuminated the liquidity-driven nature of the move. Gold and silver markets are deeply intertwined with derivatives, particularly futures contracts that allow for high leverage. As volatility spiked during the sell-off, these markets experienced aggressive liquidation. Once pressure eased, the rebound was equally aggressive. Short covering, options-related hedging, and the reestablishment of positions all contributed to sharp upward price movements. However, the metals rebound also reflected a separate layer of liquidity logic. For institutional participants, gold in particular functions as a balance sheet asset rather than a growth asset. When liquidity conditions deteriorate, gold is often sold alongside risk assets to meet cash needs. When liquidity conditions stabilize, gold is frequently repurchased, not as a speculative bet, but as a hedge against the very instability that forced its sale. This explains why gold could rise alongside equities without implying confidence in either. Silver's behavior was even more revealing. Its thinner liquidity and higher volatility made it especially sensitive to positioning. The magnitude of its rebound suggested that the prior sell-off had pushed positioning to extremes. Once those extremes were unwound, prices snapped back violently. Such moves are characteristic of markets dominated by leverage rather than end-user demand. From a structural standpoint, the recovery demonstrated how modern markets are increasingly governed by flow dynamics rather than valuation. Algorithms, risk models, and regulatory constraints shape behavior more decisively than economic forecasts. When enough systems are aligned, markets can move enormous sums with little regard for underlying conditions. This reality posed a challenge for interpretation. Traditional analysis often assumes that price movements reflect collective judgment. In this case, price movements reflected collective constraint. The market was not expressing a view about growth, inflation, or earnings. It was resolving a temporary imbalance created by forced selling and subsequent forced buying. For decision makers, the implication was clear. Liquidity-driven recoveries are inherently unstable. They depend on conditions remaining favorable to the mechanisms that produced them. If volatility were to rise again, if funding costs were to increase, or if another shock were to disrupt balance sheet capacity, the same processes could reverse. Therefore clarified that the $4 trillion recovery was less a story of belief than of necessity. Capital moved because it had to, not because it wanted to. Understanding this distinction was essential because it reframed the recovery not as a foundation for stability, but as a temporary equilibrium sustained by fragile mechanics. We're talking about the strategic implications of today's rapidly changing economic landscape. What do these shifts mean for you, your business, and your investments? Let's unpack it together. The world we operate in is more interconnected and volatile than ever before. Geopolitical tensions, technological disruptions like AI, and shifting consumer behaviors are not just headline news. They are active variables that must be factored into every strategic decision. For business leaders, the old playbook of 5-year plans is becoming obsolete. The new name of the game is agility. So, what does this mean in practice? First, it means embracing dynamic resource allocation. Instead of locking down your budget for an entire year, think in terms of quarterly sprints or even more frequent reviews. This allows you to pivot quickly, doubling down on what's working and cutting losses on initiatives that aren't gaining traction. Ask yourself, is our capital allocation process flexible enough to seize unexpected opportunities or mitigate unforeseen risks? If the answer is no, it's time for a redesign. For capital allocators, the lens through which you evaluate opportunities needs to be wider. It's no longer enough to look at a company's balance sheet and historical performance. You need to assess its resilience. How robust is its supply chain? How adaptable is its leadership team? Does the company have a culture of innovation that can weather technological shifts? These qualitative factors are becoming just as important as the quantitative ones. The most successful investors of the next decade will be those who can accurately price in this adaptability premium. Let's talk about technology, specifically AI. It's the elephant in every boardroom. The strategic implication here is twofold. First, you need an offensive strategy. How can you leverage AI to create new products, enhance customer experiences, or optimize operations? This isn't about just buying a new piece of software. It's about fundamentally reimagining your business processes. It requires investment, not just in technology, but in talent and training. But you also need a defensive strategy. What happens when your competitors deploy AI more effectively than you do? What are the new vulnerabilities and risks that AI introduces, from cybersecurity threats to the ethical implications of data usage? Business leaders and investors must consider both sides of this coin. Ignoring AI is not an option. You either shape your future with it, or you will be shaped by those who do. Another critical strategic implication is the focus on talent. In a world of constant change, your people are your greatest asset. The ability to attract, retain, and re-skill top talent is a massive competitive advantage. For leaders, this means fostering a culture of continuous learning. Are you providing your teams with the tools and time to develop new skills? Are you creating an environment where experimentation is encouraged and failure is treated as a learning opportunity? For capital allocators, a company's approach to human capital is a key indicator of its long-term viability. Look for companies that invest heavily in their people. These are the organizations that will innovate faster, adapt quicker, and ultimately deliver superior returns. High employee turnover and a stagnant skill base are significant red flags that traditional financial models might miss. Now let's consider the macroeconomic environment. We've seen cycles of inflation, interest rate hikes, and recessionary fears. The strategic implication is the need for financial resilience. For businesses, this means managing debt levels carefully, maintaining healthy cash reserves, and optimizing working capital. It's about building a financial fortress that can withstand economic storms. Stress test your financial models. What happens to your business if revenue drops by 20%, or if your borrowing costs double? Having a clear-eyed view of these scenarios allows you to prepare proactively, not reactively, in a crisis. For investors, this environment demands a more nuanced approach to risk. The days of simply betting on broad market growth are fading. It's about being selective. It's about identifying companies with strong pricing power, durable competitive advantages, and prudent financial management. It is also a time to look for value in sectors that may be temporarily out of favor, but have strong long-term fundamentals. Patience and discipline are paramount. Let's tie this all together with the concept of the anti-fragile organization, a term popularized by Nassim Nicholas Taleb. While a resilient system withstands shocks, an anti-fragile system actually gets stronger from them. This should be the ultimate goal for every business leader and the key characteristic every capital allocator looks for. How do you build an anti-fragile business? It starts with decentralization. Empowering teams at the edges of your organization to make decisions allows for faster responses to local changes. It involves building redundancy into critical systems, whether it's your supply chain or your data infrastructure. It means embracing a portfolio approach to innovation, placing many small bets rather than one large, risky one. And most importantly, it requires a leadership mindset that views uncertainty not as a threat, but as a source of opportunity. As a capital allocator, identifying anti-fragile companies means looking beyond the surface. It's about understanding the culture, the decision-making processes, and the strategic foresight of the leadership team. Does the company learn from its mistakes? Does it have a history of successfully navigating downturns? These are the hallmarks of a business that doesn't just survive, but thrives on chaos. So, let's bring it back to you. What are the actionable takeaways? First, as a business leader, audit your agility. Review your strategic planning, budget allocation, and decision-making processes. Are they built for speed and flexibility? If not, start the conversation about how to change them. Second, put technology and talent at the top of your agenda. Develop a clear and comprehensive strategy for both. They are the twin engines of growth and resilience in the modern economy. Third, build a financial fortress. Stress test your business and ensure you have the financial runway to navigate economic uncertainty. Don't wait for the storm to hit to check if your roof is leaking. For capital allocators, your takeaway is to expand your analytical framework. Look beyond the numbers. Assess a company's adaptability, its culture of innovation, its investment in talent, and its overall resilience. Price in the anti-fragility. The future is uncertain, but that doesn't mean we have to be unprepared. By understanding these strategic implications and acting on them decisively, we can position our organizations and our portfolios not just to survive the changes ahead, but to prosper because of them. The challenges are significant, but the opportunities for those who get it right are even greater. It's about shifting from a mindset of prediction and control to one of adaptation and influence. That is the true mark of leadership in the 21st century. Thank you so much for joining me today for this deep dive. I hope you found these insights valuable for your own strategic thinking. If you enjoyed this video and want more content on business strategy, leadership, and finance, please make sure to hit that like button. And don't forget to subscribe to the channel and turn on notifications so you never miss an update. I appreciate you all, and I'll see you in the next video.